welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Bob Pisani. This will likely be a record year for the IPO market. The fall season, chock full of big consumer names going public, including Warby Parker, that's a direct listing, Fresh Market, Allbirds, Instacart, Chobani, Yogurt, Sweetgreen, Impossible Foods. Here to talk about it, Kathleen Smith from Renaissance Capital. She's an advisory firm to IPO investors who also runs the Renaissance Capital IPO ETF. That's a basket of the most recent 60 or so IPOs. Brian Schaefer's here as well, managing director at InvestX Capital, which is enabling a marketplace for private securities transactions, allowing employees and shareholders to get liquidity while the company's still private. Kathleen, first 8 months, I have 279 IPOs, raised $96 billion. How about the overall outlook for the final 4 months? And you think this could be a record year, right?
Well, we think so because when the returns on the already trading IPOs are doing well, and that is the case with our index, the ETF tracks that index, returns had been great in 2020, up over 100%. And that put out a slew of companies into the market, that receptive market. And then we're seeing in recent months, again, outperformance of the segment. And so we're predicting that we're going to have a very big year finishing up with more IPOs than we've seen since the internet bubble. And the amount of dollars raised, which could be about 125 billion, that'll be more than the IPO market has ever seen.
You know, and what's striking to me is normally we have to explain software companies and biotech companies and what they do, but so many of these names that I see coming are big consumer names. Warby Parker, Fresh Market, Authentic Brands, a lot of others. Is there some kind of zeitgeist in the air where suddenly big consumer names are going to be going public?
Well, I think it's good to see breadth of that sort in the IPO market. And if you look back year to date, you'll see some of the best returns have come from the consumer discretionary names. So because of that, and the technology companies that are often the bread and butter of the market, they seem to be getting a bit pricey, high in valuation. So the ones that have performed well have been consumer discretionary, so it should be no surprise that we're seeing a lot of these names. And it makes it kind of fun because now we don't have to describe what Chobani does.
Yeah, and there's a number of other well-known consumer brand names that have not yet formally filed but have a pretty good chance of going public next year, this year as well, Kathleen. And I'm just very impressed with the list.
The list is great. We're going to see Warby Parker try to do a direct listing, and we think that could be $1 billion of issuance at maybe a $3 billion or so valuation. We have some other really big names, Authentic Brands, which ought to be doing $1 billion plus IPO, and that's a licensor of brand names like Brooks Brothers and Nautica, and a company called Freshworks. They're a little bit like Zendesk, very fast growing, and again in the $1 billion category. Once we got back from Labor Day, we just saw a tremendous quality of company get onto the IPO calendar. So next week, we're going to see over $3 billion of issuance. And they're from companies that all have valuations of over $1 billion, some up to $8 billion.
Yeah, and we're putting up a list right now here, including ThoughtWorks and Definitive. Rivian's another one that's a potential IPO company that's out there. I'm wondering if you think all of these are going to be coming. Obviously, the most important thing is the state of the market. So far, the market's been holding up very well. Are we going to see a sudden rush in the starting next week, where in the next 3 weeks, you're just going to see a massive number? What does the calendar look like?
The calendar is filling up now. So I would say we're seeing a rush. Now, the one important thing about the IPO market is there's a pricing mechanism here. And these companies are all going to be compared to already traded public peers. So if the overall market goes down, the pricing will be adjusted on these IPOs. They should be. If not, the deals won't work. And that is important because if deals don't work, then investors stop participating. So I think if the IPO mechanism has been working just fine. I don't see why it wouldn't. And unless we get to some really big corrections, I think the pricing mechanism will give us deals that have values that make sense to investors.
Yeah, you know, Brian, let me turn to you. It's striking that some of these companies have been private for many, many years. They used to be companies would be private for 5 years, you know, and then go public. But now I'm seeing companies that are private 10 years, even 15 years before they go public, and they're still private here. So tell us a little bit of what kind of opportunities are available for people who want to buy or sell private securities, and what are you doing to help that?
So, I mean, that's a great observation, Bob, and I'll tell you that there has been a massive paradigm shift, obviously, within the industry, and I would say that's now the norm, right? So you're seeing companies stay private 10 to 15 years because you've had a handful of the largest buy-side investors getting involved, injecting cash and liquidity into these companies at very early stages. We're talking B and C rounds. And at that point, they no longer need to go to the public markets for liquidity. And so, again, that new trend that we're seeing, and as we say down on the floor of the exchange, a trend is your friend, is companies are staying private longer. And so having access to that and thinking about how to democratize the process of investing is something that's very important and is on our mind quite a bit, as we know that the regulators are looking at it very, very hard. And as the regulatory dust settles, we want to find ways to
explain how this works. So right now, under your company, if I had shares I wanted to sell, I would go on the platform and seek a brokerage company. You'd go through the brokerage company, right?
That's right.
And then the company you still need approval of the company itself.
That's
right?
exactly right. And again, it's a great point. There's a lot of snafus in investing in private companies. It hasn't been electronified the way investing in public companies has. You can't hit the button and buy shares in a millisecond the way my algorithms that we built in the past have done. Today, this process could be very long and arduous. It could be days to months by the time, and again, by the time you get in front of the companies to find out if they are going to ROFR those shares. And the ROFR is the most important part of the process because it seems to be the most...
ROFR meaning?
ROFR meaning the right of first refusal. And so to your point of the question, which is those companies have the right, if I were to go to them as an early employee and say, I'm about to sell my shares for $20 to someone, they can say, we have the right of first refusal to say, no, we'll pay you the 20 and take those shares back, whether into Treasury or for whatever reason.
This is still a pretty antiquated process. It's really like an over-the-counter transaction, essentially. So if I'm at XYZ company and it's been private for 10 years, not going public, and I own 10,000 shares, pick a number, and I want to sell 1,000 shares, it's actually fairly difficult to do that right now. You're trying to find some way to not automate the process, but do more electronic kind of trading.
Yeah.
But you still have to get the approval of the company, and you still have to have selling shares. You still have to get the company approval. And you still have the fact that this has to be a qualified individual, right?
That's exactly right. And so there's a number of different checks you need to go through. And today it is extremely antiquated and high touch. And that is the reason that InvestX exists today, is because our very ambitious goal, while ambitious, we don't think it's impossible. It's not, this isn't rocket science. At the end of the day is figuring out a back office rails so that when you want to make an investment, or if there's a ROFR process, that it can be automated / electronified. And that's very important.
So is there an ETF angle here? So, for example, could you ever envision a process whereby you can actually get private companies in an ETF as a group and trade it as a group?
Funny, I had just a meeting this morning with one of the largest ETF issuers out there who is very aggressively seeking to do exactly that, which is build an ETF around private companies. And if you think about really the larger U.S. consumer, the larger swath of the consumers who are not accredited today have no access to private companies. And the SEC has inadvertently made the rules, such as what their definition of an accredited investor is, have inadvertently made it very difficult for the masses, if you will, to invest. And so we believe that's kind of where the puck is going, not where it's at. And there are specific ETF issuers who are seeking SEC approval to come up with ways in building baskets around private companies.
Kathleen, what's your take on this whole thing? Number one, what do you think about the ability? Should people have an ability to buy or sell shares in a private company, as Brian is essentially trying to set up? And why are companies staying private so long? It used to be 5 years, and with the venture capital, they want it out. Now I see 10 years and more with venture capital firms.
Well, we would comment that in the private market, I think the most important thing for all markets to work well, it's kind of like the Amazon. The more information you have about what you're buying and selling, the more transparency, you have a better marketplace. And that's why I think the IPO market has worked so well. There's a requirement for disclosure, audited financials, and stuff like that. So the more that Brian's efforts enable investors to access with good information, then I think the growth ought to be there, and I think it's a noble effort. I myself think that the SEC should get rid of the accredited investor rule. It doesn't seem to make any sense to me. Investors can know what they're doing. So I think that it's a good approach. I would say that in answer to why there's so many companies that have stayed private, back during the Jobs Act, the SEC put in a regulation, or relieved a regulation that said if you had so many shareholders, and it was I think 500, you then had to go public, because basically once you have that many shareholders, you effectively need to tell them what do the financials look like and stuff like that. Well, they extended that number to like over 2,000. And so that enabled companies to stay very big and not to go public. And okay, that's fine. We're in a point in time right now where there's a lot of capital available.
Yeah.
And
Right.
it makes it easy. But remember, there are times when we know the IPO window can be closed and capital is not available.
Right.
And it's important for companies to get the fact that they have traded shares, liquidity can really give them a benefit of being able to use that stock to raise additional capital, to make acquisitions that they would not have if they stay private.
Right. But I mean, other than the change in the SEC rule for 2,000 shareholders, isn't the simple answer that capital is really cheap and it's easy for these companies to stay private? Why bother going public when your venture capital firm, you'll do a series A, B, C, D, E, F, G, H. We've gone through the alphabet with some of these rounds of funding that are going on. Why go public when you could get cheap money for the rest of your life, essentially? Isn't that the real answer?
Right. And the equations sort of flip-flop, because generally speaking, these valuations should not be as high as they are. I mean, we've seen a lot of IPOs that are done at valuations that are lower than their last rounds.
Right.
So the fact that capital is running to these companies, it's not the best formula, but look, we've been in all kinds of markets. Markets adapt. That's what they are.
Brian, what about access to information that Kathleen was talking about? Today, if you want to invest in a private company, it is really hard to get information. She's right. It's
nearly
you used the word asymmetrical.
Yes, and that's exactly what it is.
So what are you going to do? How do you make it possible?
Right. So when I say asymmetrical, only from the sense that the larger investors that we spoke to earlier, involved in those earlier rounds, do have access to the company's financials or otherwise. And so, again, Kathleen brings up a great point, and as we're sitting here in this great institution that once had a point of sale, which, not to the extent that it used to be, but again, price discovery is a big part of the challenge for investors in private companies. And so that's another one of the things that we try to provide on our platform, which is access to financials, albeit some of it publicly sourced, but others that we gain access to directly from the companies, and after ascertaining that, put that on our platform for our broker community and our broker partners to share with their customers, and so that they can make more informed decisions in their investments.
Yeah. Kathleen, one of the disappointments with IPOs this year has been the poor aftermarket performance. IPOs on average lost money, as you have noted, after the first day of trading. Now, why was that happening, and is there any improvement recently?
Well, there's definitely been an improvement recently. The aftermarket returns are positive now for the last 3 months. I think it's about 12%, which is very good. But if you drag along the full year, they're just about break even now. When aftermarket returns go negative, investors start to step back, and you don't get the follow through that you want with a priced IPO. So that signals a slowdown in interest, and therefore a slowdown in the IPO market. We saw that in terms of issuance. We saw that slowdown this past summer. We also had a slowdown related to the Chinese IPOs that were done. Those performed very poorly, so that dragged down the aftermarket returns too.
Yeah.
And so we go through a cycle. Now we're at a better phase of the cycle. Valuations seem to be pricey, especially for the tech companies. So then you see the new ones come in, they're priced better, the aftermarket returns improve, and the cycle kind of starts over again.
So it strikes me as two things happen. When I saw the IPO ETF drop notably, it was February, March. That's when interest rates also moved up, and obviously higher rates affect some of these younger startup growth companies, which are valued less on a discounted cash flow model. I think that's probably a major issue. But also, prices were too high. Are you saying that we've seen the IPO ETF do better in the last month or so? Is this because in July and August, the IPOs, the price were lower priced and they're performing better in the aftermarket, after they start trading?
I think that it's a little bit of that because the ETF is including companies that are already public and just on the quarterly basis will pick up new ones. So I think it had to do with the performance of growth companies, as you mentioned, when interest rates appeared to be rising. It's not happening now. But if rates go up, it does affect the value of growth companies. Now, we seem to have turned around, and we're in a market where investors just want growth. They're ignoring anything that's not growing. So investors are willing to pay a lot of money for growth when interest rates the real return is negative on any kind of fixed income product. So in terms of yield, you really value then a company that can produce growth and cash flow. And interestingly enough, unlike 2000, the cash flow is very good on most of these companies.
Yeah. Okay. I'm going to leave it there, Kathleen. Thanks very much. That does it for this edition of ETF Edge. My thanks to Kathleen and Brian. We've asked Kathleen to stick around and chat a bit more about IPOs and SPACs and direct listings. I'll get her thoughts on that for our ETF Edge podcast coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.